Welcome to Before and After, powered by Refinitiv. I am Jamie McDonald, and we are going to explore the scenarios of small edges and big swings, all in the hopes of bettering our financial positions. In the Before segments this week, we look at US non-farm payroll and German exports. And for our After segment, we revisit the Salesforce earnings announcement that we discussed last episode. Let's get right into our Before segment. Everyone from Jerome Powell to Donald Trump is looking towards US non-farm payroll numbers, a key economic indicator and a harbinger of things to come. The 2019 recession that never was could be credited to the US jobs market holding strong, and this week we will see our last reading for the year in the form of the November non-farm payroll. A 180,000 November non-farm payroll rise has been forecasted, following a 128,000 increase in October. This strong forecast reflects a reversal of the UAW-GM strike that limited the October rise and includes an estimated 40,000 bounce in factory jobs after October's drop. While the December FOMC meeting is not expected to generate any fireworks, US non-farm payroll will very much be a number that sets the table for 2020's agenda. Here's what we discover in parsing October's mixed data. Non-farm payroll data showed the US economy added 136,000 jobs below the expectation of 145,000. The lone bright spot was that unemployment dropped from 3.7% to 3.5%, the lowest level since December 1969. This is consistent with the not too hot, not too cold scenario that the markets currently prefer. Here is what we face with the announcement. The outliers scenario of either a massive beat or a massive miss on the non-farms could trigger a stock sell-off. The massive beat scenario could also initiate a bond sell-off, but a big miss on non-farms would certainly see 10-year yields starting to sniff around the notion of further cuts. All things being equal, a number near average would be bullish, putting us in that Goldilocks range. Keep an eye on hourly wages year on year. Wage pressure has been one of the key drivers of inflation and one of the few items that spurs action from Powell and the Fed. Germany has the 17th largest population in the world, and according to the Economic Complexity Index, the ECI, has the second largest export economy and the third most complex. It is widely understood that the global trade war is having a very real impact on the German economy, but nobody seems to have informed the DAX of this. 2019 has seen the DAX climb the proverbial wall of worry and rise 23%. With the German 10-year bund yield at minus 0.348 basis points, perhaps investors are being forced into owning stocks. Last month's German export figures produced an upside surprise, an expected 0.3% gain over-delivered at 1.5%. This is a considerable uptick in exports, but if we look closer, some companies are behind the curve. Continental manufactures trucks, autos, tires and parts, even bicycle tires. It's one of the few down large caps in the DAX in 2019. Not exactly a disaster, down 3.5%, but it is enormous if you consider the 26.5% total underperformance. And although autos comprise the largest exports component for Germany, and one would expect the strains of global trade to appear in German autos, they simply haven't. Take, for example, Volkswagen. That is up 25% year-to-date, outperforming even the DAX. Continental is that solid instance where the stock is performing weaker, as one would expect a company that is dependent on export. We can take this to mean that the bottom in trade has been priced into the DAX, and that trade war concerns were not. That is, of course, until earlier this week. Another over 1% month-on-month gain in exports would validate the bull case that the bottom might be in on German weakness. The question is if that is enough to validate further stock gains. Keep an eye on Continental's reaction to the export figures. The stock is already 26% off of 2019 highs, but the sell-off occurred as the DAX broke out to the upside, a very bearish price action indication. An export beat with no pop in the DAX and selling in Continental would be the most obvious indication that a short-term top is in place. Salesforce is living up to its name. The company beat on both earnings per share and revenue. EPS was announced at $2.90 against an estimated $2.84, and revenue came in at $4.51 billion, besting the $4.45 billion estimate. Add to that subscription revenue growth of 34% year-on-year, and CEO Mark Benioff proclaimed, "We're on track to double our revenue in 5 years." However, Salesforce EPS guided lower through Q4 and Q1, and the stock sold off over 2% in the aftermarket session. It will be interesting to see whether the weaker guidance is a Salesforce-specific case, or if other companies will follow suit. US Non-Farm Payrolls, German exports, and Salesforce, a company that refuses to be stopped. This was Before and After, powered by Refinitiv. I am Jamie McDonald, and I'll see you next episode. Be sure to like, subscribe, share, and click the bell for notifications about future episodes.